white candlestick, which means that the open price has been lower than the close price, and when the close price is above the open price, a white or a hollow candlestick is formed. Of course, in order to create the candlestick, you need certain data like the open, the high, the low, and the close values of each time period that you want to analyze or you want to display. The hollow or the filled candlestick is called the real body of the candlestick, and the long thin lines above and below the candlestick are called tails or shadows. The high is marked, the high price is marked at the top of the upper shadow, and the low price, here actually that's low price, not close price. So the low price is at the bottom of the lower shadow. As we said, if the price closes higher than the opening price, a hollow candlestick is drawn, and the bottom of the body represents the opening price, and the top of the body represents the closing price. Of course, we also have the filled candlestick, where the open price is below the close price, and the top of the real body represents the close price, or the bottom of the real body represents the open price. Again, we have the lines above and below, and again, the top of the shadow is the high price, and the bottom of the shadow of the lower shadow is the low price. Let's look at some candlestick patterns. The first one that I would like to show you is the Marubozu candlestick pattern. That's the first one. It's a long white candlestick, shows a strong buying pressure in the charts. The longer the white candlestick is, the farther the close is above the open price. So we can see here that the close price has been above the open price, and the longer the candlestick, the higher the close price than the open price, and it indicates that the bulls have been more aggressive. Of course, on the Marubozu candlestick, we don't have shadows. They are mainly just real body candlesticks, which indicates that the range of the price was between the real body of the candlestick. At the same time, we can have a Marubozu black candlestick, bearish candlestick, and which is when the close price is below, is formed when the close price is below the open price, and the farther the close price from the open price, it indicates that the bears have been more aggressive. We can see that on a chart. Let's look at the chart and try to find one. So here we have one black Marubozu candlestick. That's a black Marubozu candlestick. There is a slight thin line above the black candlestick, but we can ignore that because there is always volatility in the market. There is always prices that can exceed the real body. However, that can be considered as a Marubozu black candlestick. And at the same time, a better indication is this one here, which after that black Marubozu, we can see that prices went even lower. Anyhow, let's go to the next one.
I guess this is one of the most rare candlestick formations, actually. That's why, Adamos, I guess you are looking into 1 minute candlestick, correct?
Exactly, yes. I couldn't find in any other time frame a black Marubozu candlestick. Mostly exist in theoretically, but of course, when we see a black candlestick, we can just identify that there was bearish power dominating in the trading session. And
one thing that maybe I could add is that based on my personal experience, Marubozu candles actually take place during the times of crisis or prosperity. Meaning,
exactly, yeah.
There is a crazy news coming out, you would then be seeing this candlestick formation, because the candle just opens and shoots down and then closes and then continues bearish. Then it's just continuation candlestick formation in general. Such example was January 15 last year. If you take a look at different types of charts from last year, you would see a number of these happening. And the good thing is that today we have the FOMC, so there is a possibility to see this kind of candlestick. But next week, because of the Brexit voting, I guess we would have it there as well. Back to you, Adamos.
Okay, thank you, Jakub. So let's erase this and go to the next one. Of course, in order for Marubozu to happen, we need the bulls, for a wide Marubozu, the bulls to prevail at all times during the trading session, and for the bears to prevail at all times during the trading session for a black Marubozu. Anyhow, let's go to the next one. The next candlesticks that we can look at is the long shadows, the first one. So the long and short shadows candlestick can give valuable information about the market session mainly, and upper shadows are actually exhibiting the higher range of the trading session, and lower shadows exhibit the lower range of the trading session. In addition, this candlestick indicate that price range has extended farther than the open and close price, farther than the real body of the candlestick. A long shadows is candlesticks with a longer upper shadow. We can see that here. This is a candlestick with a longer upper shadow, indicate that buyers dominated during the session and bid prices higher. So they took the prices higher in the beginning. However, sellers later on forced the prices down from their highs and came down to close at this level. At the same time, the candlesticks with the lower shadows, it's this one. The price has opened. Let me show where the price has opened. The price has opened here. Then prices went down where the sellers have been prevailing. However, the buyers have recovered during the session and drove the prices higher. They created a wide body for the candlestick, and eventually indicates that the buyers had the last word in the trading session. Maybe we can find another one like that in the charts. So we can see here a higher, an upper shadow where we can see that there have been a bullish candlestick before that. Then prices drove to a new high here. However, later on the sellers took the control of the trading session and drove the prices lower, and we have seen a black candlestick formation there. The next one that we're going to look at is the spinning tops. Usually they are formed at the tops of either an uptrend or a downtrend, or after a bullish or a bearish candlestick, and they are actually candlesticks with a long upper shadow and long lower shadow. Mainly the shadows are equal in size, and they have a small real body called the spinning tops. One long shadow represents a reversal of the trend at that point in time, and of course the word here is indecision. The investors and the traders have been in an indecision. They have been trading between this range, and they have created a spinning top. We can identify that neither the buyers or the sellers could gain the control of the trading session, and that eventually we saw a spinning top formation in the chart. Usually, as we said, when you have an uptrend, it's formed at the top of the uptrend, and or after a long white candlestick, a long bullish candlestick. And the black one usually is formed after a downtrend or a long black candle. The next candlestick that I would like to ask you, what do you think is this one? It's one of the most identified or the most used candlesticks in the technical analysis, and it's actually called, maybe you have heard about it again, it's actually called Doji Candlestick. That's a Japanese word and comes out from Japanese. They call it Doji. They have a long history for this. So mainly the Doji candlestick can have either a small real body or just the open price will equal the close price. The length of the upper and the lower shadows can vary and can be different than what we see here. Either the upper shadow can be longer than the lower, or the lower longer than the upper shadow. That doesn't matter much, because what we're looking mainly is what is behind this candlestick, and again, behind this candlestick is indecision of traders and investors. Of course, ideally, it's that the open and close should be equal. And with this, if the open and close is equal, then the doji is considered more valid. But of course, as we said, we need to look at why this has happened, and mainly has happened because the bulls or the bears did not have any control over the trading session, and they created this candlestick. Let's see if we can see this one on the charts. So we can see this chart here, this candlestick here. We can see a black. Let me try and see if I can zoom in for that. Okay. So we can see this candlestick here. There has been a downtrend, and we can see that there was a doji candlestick. You can also, it's not a spinning top because the lower and the upper shadow is not equal. It's a doji candlestick. There is a slight real body created there, which means that the open and close price is not exactly the same. However, the meaning here is that there has been a downtrend. A creation of the doji indicates that there has been indecision at that point in the market, and then we see the prices reversing the trend, the previous downtrend, and they are moving upwards. Let's look at the next candlestick, which is the hammer and the hanging man. That's a very interesting candlestick because of the name, as well because of the formation in the chart. So the hammer mainly is that one. Let me highlight it. That's the hammer candlestick, and it's a bullish reversal pattern that forms after a decline. In addition to a potential trend reversal, hammers can mark bottoms or support levels. So with the hammer candlestick, we can identify if there has been any support in the market. The low of the long lower shadow implies that sellers drove prices lower during the session. Of course, we can see that the lower shadow here indicates that the market in the beginning, the bears had the control, they drove the prices lower. However, the bulls gained momentum during the trading session and drove the prices higher, and created a small real body at the top of the formation, and that is actually creates the name of the hammer because it looks like a hammer. The hanging man is a bearish reversal pattern that can also mark a top or a resistance level. It formed after an advance or after a bullish candlestick, and signals that selling pressure is starting to increase. The low of the long lower shadow confirms that sellers push prices lower during the session, even though the bulls during the session have regained the power and drove prices higher, then drove higher prices, but failed to drove the prices above the open price. And this increased selling pressure during the trading session, it creates a warning that the bears are starting to gain momentum in the market. Then we have also the inverted hammer and shooting star. That's mainly going to be the same like the hammer and the hanging man, but on the opposite way. So let's try and create this candlestick. You can see that the inverted hammer is actually has a longer shadow above the real body and a small shadow below the real body. So that's the drawing mainly for the inverted hammer. And the inverted hammer is actually formed after an advance, where it shows that the bulls had the power. However, the bears regained the momentum during the trading session and reversed. At the same time, we have the shooting star, which is the opposite than the hanging man. Let me do the drawing so you can see. So this is the shooting star. Again, this is formed after, and of course this is a black body, and this is formed after an advance. Prices went to new highs. We can see that the hanging man, actually, it seems like this one here that we saw before. That's more representative. So prices went to a new high. However, the bears gained momentum and control during the trading session and drove the prices down and lower than the open price and created a black real body, which suggests that the bears are gaining control. Of course, all these candlesticks should be used after an extra confirmation. They shouldn't be used on its own to take action. And the next one that we're going to see, the next candlestick, it's the engulfing candlestick. So let's see the engulfing candlestick. So it's a two candlestick formation, and mainly can be either bearish or bullish. It depends on the formation. So we see here that we have a black candlestick, which means it's a bearish candlestick. The open price is above the close price. And in order to have an engulfing one, we need to have another one after that, which should be something like that in the charts, of course, where the new white and bullish candlestick engulfs the previous one and creates bullish expectations, because it includes all the previous candlestick price range into the new one and creates a new high, a new close price higher than the previous one. At the same time, the bearish, that's, by the way, a bullish engulfing formation, and the bearish engulfing formation is going to be a black candlestick, a bearish candlestick engulfing the previous one. So the drawings are not so correct. The lines are a bit okay. Anyway, so there is a black candlestick where it engulfs the previous one. We can see that the open price was above the close price. The close price now it's a new low, and there has been also a new low during the trading session. That's a bearish formation and creates bearish expectations for the following candlesticks to follow. Next one, we have long days. That's just one candle formation. They are separated, they are not followed by each other. Long day means that the open price and the close price are very far away, and actually this is when we have a bull of long day candle, it means that the trading session bulls have been very aggressive and drove the prices high, farther away from the open price. At the same time, the long day black candle indicates that the bears have been prevailing in the market. They have been very aggressive and drove the close price much farther than the open, much lower than the open price. Lastly, I would like to look at some other candles. I'm going to candlestick formations. I'm going to form them here for you. So the first one is the evening star, which is a 3 candlestick formation. Initially, the evening star has a white and bullish candlestick, or a previous uptrend. It's in the market before the formation of the evening star, and that's the first one, the white bull candle. Then the next one is going to be a spinning top. We saw before what is a spinning top. This is a spinning top, just to remember. and then a spinning top is created here, which suggests that there has been indecision during the trading session, as we said before. That should be smaller. So we have the second one is a spinning top, indicating that there has been an indecision. It can be either a slight bull spinning top formation or a black one, doesn't matter. And the next one, the third candle, is gonna complete the formation, where it's gonna start from the previous close price and is going to fall below. The 50% of the first candlestick that we can see here. So the evening start to be formed, it needs to close below the 50% of the first candlestick formation. Let me write it here, below 50% of the first candle. And that's the formation of the evening star. It's a bearish candlestick and gives some bearish expectations that for the momentum to follow in the market. At the same time, we can have evening doji star instead of an evening star, which is mostly the same. However, the difference is that the second candlestick, it's doji. Therefore, the formation will be something like that. And we can. So after the white candle, we can see that a doji star will be formed, and following the doji star, we might see a black candle formation, which completes the candlestick formation and suggests that the bears will gain momentum in the following trading sessions. Of course, as we said before, the last candlestick has to be below the 50% of the first one. So that should be the 50% of the first one candlestick to be able to identify that this formation has been created in the market. So let's start from the USD yen currency pair. We can see that on the weekly time frame, prices are on a downtrend. They have been on a downtrend several weeks now, and they went down to 105.57 support level, which is a 20-month low. And at that levels, we have been discussing before that if Bank of Japan see prices of the USD yen going lower than that, could get into the market and intervene, which is something that we need to be cautious at. Nevertheless, we see the 105.57 holding well ground. Previous lows have been formed here. However, moving averages are above. The structure is bearish, and most likely the 105.57 is going to hold its ground this week. Let's go to the daily time frame. We can see that mainly the same picture. The downtrend prevails in the chart. Prices went down to 105.55.58, which is a weekly support as well. It's a very strong support. Moving averages are above prices. However, we can see that the MACD is bullishly diverging, which is giving an indication of the weakness, and something that I consider into my view, saying that the 105.55 is not going to be breached this week. Tomorrow we'll have the Bank of Japan announcement. There is a lot of pressure on the Bank of Japan to intervene in the market, and most likely they are going to say something in their statement. The yen is strengthening. Inflation for Japan is at low levels, and actually after all this stimulus that they did, inflation didn't recover. They still have problems with the economic growth. So that's another reason why I consider that Bank of Japan chances to intervene in the market are increasing as we go lower in the USD yen currency pair. Yesterday we had some releases about the US dollar. We had the retail sales which were slightly better than expected, however not so much, and we can see if we go to the week intraday time frame, we can see that the USD yen is recovering slightly today. Perhaps this positive news about the US dollar and the strong support at 105.58, it gives some recovering momentum to the USD yen, which could also, it's something that we need to keep in mind. As we move on towards the Bank of Japan release, prices of the USD yen are recovering. Most likely it's going to go into sideways formation ahead of the Bank of Japan. And lastly, and one of the most important things is the FOMC statement today, where the Janet Yellen is going to release her statement about the monetary policy and the FOMC members' decision about the interest rates. I don't expect any change today. Most likely the rates are going to stay the same. There has been a lot of discussion that they're going to increase the rates in June. However, the weaker job reports and the global risks doesn't allow for the Federal Reserve to increase rates. And they are going, most likely they're going to say that in their statement. They're going, I expect to see something in the statement saying about the global economy risk again after the previous time where they ignored it, and that most likely is going to give a dovish tone to the Federal Reserve. And with that said, the US dollar may get under pressure if the FOMC statement is more dovish than expected. The US dollar recently actually has been strengthening against the most of its currency pairs, not against the Japanese yen, but against the British pound, against the euro, has been strengthening. And if we see a dovish FOMC, then most likely the US dollar is going to weaken. We might see the USD yen testing again 105.58. However, we have the Bank of Japan in our focus, and I don't expect the 105.58 to be breached. If we see prices below 105.58, could be a fake break, and we should be very cautious. The next currency pair is the Aussie USD that I'm going to talk and analyze. We can see that the Aussie USD has went down from 0.7835 to 0.7146. That happened during the time when RBA has been dovish, and the recent white bullish candlestick that we can see here, which is a white Marubozu candlestick, was driven mainly because of the Reserve Bank of England becoming more hawkish. In 2 weeks ago, they said that they are going to keep the rates unchanged. They see economic conditions improving, and employment is improving, and their only concern was the lower than target inflation. Then in the daily time frame, we can see mainly a similar picture, but more in detail. Prices went down to 0.7144. They found support here. We see a lower rising line there, and recovered to 0.7506. At this level, it's that level. It's the 50% Fibonacci level of the last move down from 0.7834 to 0.7144, and at the same time, it creates a tentative downtrend line, which gives some triangle expectations on this on the price chart. It means that the trading is getting narrower. Indecision is becoming the most prevailing sentiment in the market. And with that said, if we see a break above or below, we can follow it in with the perspective that the break will indicate the prevailing move in the market. However, most likely is going to go higher, given that there has been an uptrend from before, and also this uptrend has been longer in place. Nevertheless, the 50% resistance level may limit the upside. Going to the intraday, uptrend is in place, as we said before. prices are testing the moving averages, and most likely if they breach this level here at the moving averages, could go towards the next resistance level, which is seen at this level at 0.7432. This is just the intraday time frame. Of course, the news prevails in the market. Mainly the market in the last week and in the following week will be driven by events. We see that tomorrow morning we'll have the employment report for the Australian economy. It's expected that the employment change will increase by 14.9K and unemployment rate will remain at 5.7%. As we said earlier, the most important event for today is the FOMC statement. We remain focused to that, and volatility is expected to increase towards the FOMC statement release. Of course, we never forget that we have the referendum for UK next week, which actually has limited risk appetite, and when the risk appetite is limited, the Aussie USD gets squeezed because the Australian dollar is a higher risk currency pair. It gives higher returns, and investors looking for higher returns are going towards the Australian dollar. Therefore, the risk averse that is prevailing in the market in the last week has also weighed on the Australian dollar.
On USD Japanese yen, based on my Fibonacci analysis as well, I am convinced that there will be sellers getting stronger again, but the level that I'm looking for sell opportunities will be remaining at 107.70 level. Meanwhile, I would only be buying actually the Japanese yen from 103.87. So I'm looking for 103.87 level to long the pairs. If you go backwards as well, you can see that. Let's actually take a look at it. This is the line that I'm talking about, and you can see that it has been as some kind of minor resistance back in July of 2014. It was a massive reversal level again in March of last year, and it has been tested as a support level as well. So that's indeed the reason why I believe that this is the level that we can expect to see the most and the foremost important correction wave or reversal level. And it also gives us another level as well in mind, that if the market breaks below yesterday's lowest low, which was basically at 105.60 level, we can expect first minor support at 105 level, which is kind of a psychological resistance support level, and from there onwards go down still towards the 103.85 level, and then Bank of Japan intervenes and we see the upward move. That's my projection for the USD Japanese yen. Now let's move on to GBP USD. What can we do? Well, if you remember last week, I was telling that sell GBP USD. That was it. And we said initially that 1.41 is going to be the first target. And the next target that we said was going to be at 1.40. So the first target was reached yesterday. We had the 1.41 level slightly being breached, not really much. It's only 15-20 pips of breakout below. At the moment, what I'm expecting is the pair rising once again towards probably to the level of 1.43 level, where we have the next resistance support. I do not expect a break above the 1.4325 level. So you can say that 1.4333 level could be possibly your stop loss if you are going to be shorting it from this level. Meanwhile, you could be aiming to short this pair from 1.4311 level. So 1.4311 sell around 30 pips of stop loss, and you have your take profit standing at 1.40 level. That could become our take profit target for the cable. Moving on to euro dollar, Well, we discussed it once again last week with Adamos that because of the Brexit risk involved in the market, there is a higher pressure on euro than any other currency pair. So that being said, I'm still convinced that euro is supposed to be going further low for the day. Today, I wouldn't really trade it. However, if you are shorting it, your target, I believe, should be at two levels. One is at 1.1145 level, which is approximately 61.8% Fibonacci retracement zone. And the next and the most important level should be at 1.10 level, which is psychological level. So this is for the euro dollar. Now the main thing, the gold. We discussed it again earlier, saying that gold is going to be rising, and the thing about gold is that it is not the time to buy it at the moment. I'm not convinced that it is a good level to buy it. So that being said, I'm convinced that the possibility for gold long opportunities stay at the level of 1268 level, just a little below the 100-hour moving average. So you can see that this level that I'm talking about, basically the zone over here, has been a massive support resistance level. And that level needs to be broken, well, tested and then reversed back in order for us to see the bullish development. And I do expect it to take place today, by the way. But again, I wouldn't place a pending sell or buy limit order at that level. We need to see it. We need to see it confirmed, and then we can enter it. What would be the confirmation? You just put 100-hour moving average on your gold chart, wait for it to be tested, and wait for a candle to reverse back and close above the 100-hour moving average, and then you just enter long. Your target for it should be initially at 1300 level, but I am more than that, aiming for 1341 level for gold. I'm convinced that 1341 level is going to be the most important bullish target for gold. Now let's move on. Few other currency pairs, but the most important one for me at the moment is the Euro Swiss franc, and the reason is quite simple. The SNB cannot afford selling Swiss franc anymore, given the fact that people are dumping euro. They are buying Swiss franc, and that pushes the Swiss franc to get strengthened. It is just like the 15th of January 2015. So we will be expecting the Swiss franc to appreciate one more time. And the level that basically we analyzed it last week, it was last week on Wednesday, the 8th of June. We said that sell it. In the very same webinar that we hosted with Adamos, I was commenting that it is good to sell a Swiss franc. Ever since then, the market has gone approximately 160 pips down, and this is a currency pair that barely moves. 160 pips in a single week. Now I'm going to be telling it again. The market is going to be moving again on the bearish side. And if you see the Swiss franc touching to 88% Fibonacci retracement zone, which is basically 1.10, start selling it again. And that's going to be the greatest opportunity of 2016. And my target is going to be remaining all the way at 1.05. So you can ask me, what is the profit margin? Well, 1.05 is approximately 500 pips target for you. Now, the next and very final currency pair that I'm going to be looking into is the USD Swiss franc. Again, USD is expected to be under pressure today, given the fact that we have the FOMC meeting today. Meanwhile, yesterday we had a candlestick formation on daily time frame that I call it bearish continuation candlestick. And I already commented that Swiss franc is expected to get strengthened. So given the fact that we had yesterday's candlestick formation, I'm convinced that a break below 0.9615 level will break the trend again on a bearish side, and initially and immediately my target will remain at 0.9550 level, and that will be it for me today.